The broadcast is now starting. All attendees are in listen-only mode.
Hello, everyone. Good February. New month, new week. Let's make it a good one. Understand there was a little bit of a mix-up on the invites to face today, but I see that the room is filling up now. So this is what I was talking about last month. I thought there could be some give back, some air let out of the balloon of the great January that we had. Everything went up. Oil went up. Metals went up. Stock indexes went up. So pretty much everything went up. And it's possible that we're seeing the beginning of an unwind on that. Definitely seeing that in the metals. Silver leading the way. Actually saw a chart of the gold silver ratio where it looks like it could pop a little bit here, which made silver the preferred short. Much weaker than gold, more than almost 3 times weaker than gold here on this pullback in silver. Perhaps heading back to correct this. Maybe we get, I have confluence here around the $15 level. Looks to me like at least a 2 drive anyway. If it decides to pop, my view is to be selling rallies in a lot of things, including metals for a while. Even gold, I think, has a shot back towards the 1280 level. This is where major support is. This is where I believe the gold has to hold. Otherwise, we're looking at something much deeper. Triangle that Grega showed, and I've seen some other Ellioticians allow for a decline all the way back down towards 1220, and the gold will take it a day at a time. Also, part of this scenario is a nice little 3 driver and divergence in the crude oil. If it rallies back again to the highs that we had last night while I was watching a pretty boring Super Bowl, or I was sleeping, you could see how it came off this wedge line here. Pretty negative looking candle here. Massive divergence. Why can't we see 50, even 48 in the crude? Have some 50 looks like it's very viable down here at 50 and a half or so. So we had a rally 42.13. So 13, that'd be about 5 back, could even take it back to the 48 level. So careful if you're long energy as well. I think the linchpin to it is going to be the dollar. Really think the dollar should have really fallen apart after the Fed gave the dollar bears everything they wanted to hear on the statement, and that they're pausing, and instead of the dollar following through after the Fed here, it actually on a closing basis held 78.6 back. So I think there's a possibility that this higher low from here could be a launch pad for much higher prices. That would change back under 95.40, but I could see us heading back up towards 95.80 is an important number. It's a 2-week off number. And then the 96 pivot, back above the 96 pivot, I think will be challenging. This is a bit of a neckline here. So we'll see if we could get back up to here. I think there's a shot for a challenge all the way to the highs, but I'm going to take it a day at a time. In fact, there's an expression that I use: if you do the right thing today, tomorrow takes care of itself in all aspects, in trading, in our lives, etc. So dollar, unless we take out last week's low, I'm thinking that there's potential for another fairly sizable move to the upside in the dollar. What would be part of this February give back would be stock indexes. And I'm not sure that it's through yet. We're pulling back a little here, but, I don't see anything, bearish about these dots here. Here's your 1 hour. Think we could get a shot up towards 2720, 2725, and get some non-confirmations up there. Why can't we have, even if we're not going to have new lows in S&Ps, why can't we have a pullback to 2600 or 2520, 25 and a half during the month of February? I think it's possible, but I think that we're probably going to take out last week's highs first. So here's your weekly. The off number for this week by Friday for closing under 2671, that's going to be a 2-week reversal. So you may want to write that number down. So that's a theme and the narrative that I'm working with in the markets here. There is something called a February break that was really traditional in the commodity complex, not necessarily in stock indexes or the dollar. But it almost seems like we have one market where everything goes up together, everything pulls back together, and it's just a matter of degrees or magnitude of which one goes up faster. What are your leaders? What are your laggards? And I think it's going to be the same case on the way down, that some will hold up better than others. So that's what I'm looking for here in February, is a little bit of a shakeout and give back what happened in January. Give me a Y if you're with me. You don't have to agree with me. I just want to make sure that you understand my line of reasoning in the markets here. Okay, Carlo gets it. Okay, everyone gets it. Okay, great, Tom. All right, so, like everything else, we're all captains of our own ship, right? So no one controls your mouse but you. Okay, Russell. So, we're here to shine a light on some possibilities for you. As a subscriber, we're even more specific with our patterns in play, and they're excellent. I really would recommend you at least take a trial and check it out and navigate around the dashboard and take a look at our pips, which are active patterns in play, and quite a few working. In fact, Andre called this bearish move in silver. He came on Friday. He's got a nice profit in that. Blaker's trading the long side of USD MEX. So, everything, almost everything in the green. Greg still has a nice lead on the Kiwi, and Steve on CAD, and Greg on Aussie. So you get diverse opinions here in face, but you get the layout of trade entries and invalidation points and potential targets. And again, here, it's not in cement. I'm a big believer in partial profits. So, if you're short silver, you got 30, 40 cents. So you could take a portion off. You don't have to wait for 1531, which is we're only about 35 cents away. You could take part here and keep half on for the ultimate target. So what I'm saying is, you have to use your own trading mind to trade these ideas based upon what your risk profile is and your personality. And you also have a great chat room. Amanda's getting a lot of attention in my stream for pound Kiwi short last week. I think it was good for 300 or 400 pips. So all of these things more than compensate for, a 6-month subscription to ForexAnalytix. And another way to compensate for it is to talk to the guys, our sponsors, about where you're trading, to either receive a rebate check if you're here in the U.S., or if you're not, you could have that pay for your prescription if you're overseas. And a very large selection of brokers. They're the broker of brokers. So that's my look coming in here Monday. February, I'm looking for, as I said before, some of the air to be let out of the balloon with a banner January in most asset classes. So I'll be selling rallies in almost everything I've talked about until we accomplish correction levels, and then I think we could have some great longs after this is done in February into early March. So that's what I'm thinking in here. And if you didn't hear the week ahead video, you should make that part of your intelligence gathering that Blake made. I think Yasser is raising his hand. So Blake, is this what you were expecting after you produced the week ahead video? This
a whole lot of nothing.
Quiet action. Yeah. Did you say that?
I mean, it's for the week ahead video, it was really more of it's like I wanted to like take my previous week ahead video and say there's not a whole lot going on. And just kind of go with there. I was just gonna just change the date somehow, and but I mean, it's really quiet right now. One of the things that I'm obviously paying attention to, and like you said, these markets are all kind of moving together. The FX response to the equity market rally has been somewhat benign, but I think we gotta be careful because the S&P is at such key resistance here. And I know I've talked a lot about, S&P where it's at. And, we're at the 618 retracement, and we're at a lot of resistance up here. So, I think the equity market, or excuse me, the currency markets are kind of like, okay, so what do we do now? Now that we're here, and I think we're just taking some cues from the equity markets. And frankly, I think I know you were looking for a little bit higher in the S&P. Is that correct?
Yeah, I'd like to see one more high.
You'd like to see one more high,
like 27, 20, at least 27.15. I'd like to see it take out last week's high before a reversal. But what I like and what the market does, Blake, not always the same thing.
Right. That true. And I mean. And I think the FX market is looking to see what happens here with the S&P, and I should probably just do this, since we all know that that's pretty key resistance. I should probably just do that.
Okay, there's your box goes to 20. Okay, yeah, all right.
Well, yeah. I mean, it's there. I mean,
right.
Let us break out of this range and then see what the FX response is going to be.
That would be a great signal back under your red trend line coming out of that box, back inside of that channel. It almost looks like a little throw over, maybe false breakout, and you could let it do whatever it wants to do up here, Blake, but then back inside your red downtrend line, that would be a pretty good indication that things are rolling over. Yeah, I like that line.
I would think so. I would think so. And, I look at, one of the things that I'm obviously paying very close attention to, and this is one of the things that I talked about on the week ahead video, is the US dollar Mexican peso. Now I am long, I'm already long, but I'm actually looking to add. And one of the things that I love about the US dollar Mexican peso, it is a good barometer of risk appetite and risk aversion. If we have a rally in the US dollar Mexican peso, that's telling us that the peso is weakening, which is the emerging market currencies tend to show some weakness when the market is risk off. So meaning that if the US dollar Mexican peso is moving higher, that to me would be a pretty good indication that the S&P is probably going to start breaking down if it hasn't done so already. So, I look at the US dollar Mexican peso is right up here against its resistance. Now, I mean, we're right up there.
Ascending triangle. I like that. And, I knew that, US CAD kind of gave you the same market message, but I bet a lot of people didn't know USD MEX was kind of a sign for risk off too. So, great mentoring, and, that's something that people should follow. I didn't know it. So,
well, I mean, the peso is an emerging market currency. Yeah. It is. And it's a currency that, it's hard to, carry it on the short side for too long of a time, it gets a little expensive. But at the same time, you know, if you start to see a big move in it, it can really tell you, you know, a little bit about what's happening in risk appetite, so and risk aversion. So that's why I tend to follow it, and I really want to be aggressively long. I think that Mexico's got a much bigger issue with Pemex. It's largest, you know, energy company out there. So and so I think that the U.S. dollar Mexican peso may get a significant rally, and I'm looking at actually.
Let me ask you about Pemex, Blake. So, you know, a few times with different political leadership in Mexico, it's been privatized, it's been nationalized. So is the threat right now, because I believe it is private right now with the new leader, new president of Mexico, that people are worried about nationalization there?
Well, you know, it's I don't know if it's more of a, you know, a
economic thing with debt and that.
I think it a little. I think it's a lot of debt issued related, but also with the new government too. So I think it's a combination of both. Okay. Which,
it's a recipe for that. That's why Oliver left the country.
Right, exactly, and moved. He moved to Portugal. I think it's Portugal. But anyway, excuse me. But
you know, maybe we'll get some trade news this week. You know, what I'd actually like to see is, you know, maybe that they put together some kind of temporary deal, and then what we're also dealing with the 3 weeks of the government being reopened. There are a lot of news events, and then we have the State of the Union tomorrow. A lot of stuff bubbling on the oven, buddy.
Yeah, there are, and with the China-U.S. trade negotiations, there was actually just a moment ago on CNBC, Hassett, which is one of the White House economic advisors. He is Kevin Hassett is what is his title? He is like chairman of like the Economic Council or something like that. Anyway, he was just on CNBC a little while ago saying that there's a lot to do on China trade negotiations, which, you know, I mean, you know, a lot of people are hoping and praying that we're really there with China and something's going to get done pretty quickly. But, you know, you got Kevin Hassett that's suggesting otherwise. So,
yeah,
you know,
Wilbur Ross said the same thing miles away from any deal.
Didn't he say that like 2 weeks ago? But anyway, you know, I don't know. I mean, there's so many comments that are coming. They come from all over the place. It's hard to keep them all. Hard to keep them all straight. But anyway, I look at currencies like the U.S. dollar, Japanese yen, and the U.S. dollar, Japanese yen is squeezing up towards 110, which is obviously very key resistance up here. It's been a big resistance for the market as of the last few weeks. You got some currency pairs like the euro yen that it broke above 125. It squeezed past 125 on Friday, and it still looks pretty strong. But you know, if we're still that far away, you know, we're still that far away with this trade deal, then I don't know if these currency pairs are going to, you know, they have much upside left in them. So I don't know.
Did you see yields on Friday held that higher low, and you know that 10-year yield chart, and that was right before the yen explosion on Friday. So the yield 10-year.
Yeah, well, yeah, and bonds came off, and so and that's what you're trying to point out here with yields. And I have them somewhere. I have to go find where my
lower.
Is it? Are they? Oh, there they are. Yeah. So they made a higher low. So
Yeah.
I mean, I don't know if it is a tough call. I don't know if yields are going to. I don't know if I would be buying yields or selling bonds right now, especially given where the stock market is. I think if the stock market starts to, pull back a little bit, yields are going to come right back down. So I don't know if I'd be daring, I'd be daring enough to try to get in front of, this move lower in the bond market. I'm not sure if I would have that type of stomach. And this is one of those things that if yields do go down, then the dollar yen's probably going to turn lower too. So
Yeah.
we'll see. Let me remove that really quick. But as far as what to do with currencies right now, it's challenging. We do have the RBA tonight, which the guys in my office, just so you know, they expect a kind of a dovish RBA comments, and you look at the Aussie rallied into new trend highs, and now we got a bit of a reversal here. You can probably look at it something like this, a nice little trend line up here that was containing us, and we should have held this on the Aussie dollar at like 72.30, and we're kind of breaking down a little bit. I'm not trading the Aussie, but I think it's something that we should all be paying a little bit of attention to. And when you talk about the broad dollar just in general, not, and then kind of disinclude the dollar yen, the dollar index has held up pretty well. I have to admit, we've held this 200-day moving average here, this year-long trend line. We've bounced off it. Look, if there is any type of risk aversion, you see a little bit of risk aversion in the markets, you're probably going to see the dollar continue to perform well, and as a bit of a risk off, safe haven type of bid. So I can't be bearish the dollar until we get below the 200-day moving average. You can see I've got an alarm set up here. This alarm, it's set up there on purpose. I'm really not bearish until we get below that. Once we get below that in the dollar index, then we'll, I might start looking at some bearish dollar trades, not including the yen. The yen and the dollar yen kind of does its own thing. I'm talking about, the euro or the cable or the Aussie or the Kiwi. I'm really not interested in any dollar shorts unless the dollar index actually breaks down from here. So with that being said, I think one of the other things that I was very skeptical about the move on Friday. If you guys recall, Friday we had I talked about this with Dale, is that gold has strengthened. Okay. And gold has continued to strengthen, and we're getting a little overbought, divergent, yada, yada, yada. But as gold has been rallying, the dollar has actually held up pretty well. If gold or precious metals reverse a little bit, you see silver come down, you see gold come down. What does the dollar do? I would guess if these precious metals come down a little bit, the dollar might actually strengthen. So, we might see the dollar really start to take off if these precious metals come under some pressure. So anyway, just some things that I'm looking at for right now. Maybe I can get some comments from my colleagues, Steve and Stelios. Good morning, guys.
Good morning.
Hey, Stelios. Good morning, Steve.
First of all, Blake, it's Olivier, not Oliver, and he moved to France because he's French. Let's get that clear.
oh, excuse me. All right. I don't know. It's hard to keep up with everybody, and all of our traders in the chat room. I knew Oliver had lived in Mexico and decided to scat and take his family out of Mexico. So for a lot of different reasons, but France, of course. That's why you guys always say bonjour to
there you go. All right. So my my 2 cents for today. Actually, it's more like half a cent. There's not much to say. We did have a couple of minor data out of the Europe investor confidence PPI. They both missed. We had some construction PMI of the UK that missed too, and it kind of makes sense as we get closer to the March deadline. But really, it's all about the US. We have to remember that the short-term funding for the shutdown, the agreement that Trump has done is actually a short-term thing. I think it's up until February 15th. So we have a State of the Union address. Yeah, I think so. It was just enough to cover the State of the Union tomorrow and a little bit. And the main thing is what he's going to say tomorrow. But other than that, it's been a very quiet weekend, right? So apart from the Super Bowl.
Oh, I know it was quiet. That would believe me. That we had 3 TVs going at my house and no one was watching. That's how boring it was. Everybody turned their attention to each other versus watching the game. So anyway, well, I'm going to pass it over to you guys, and I want to wish everybody a wonderful week. I'll obviously be back here tomorrow, and good luck to everybody out there. As I let Stephen, you Stelios cover some of these cross rates and good luck, everybody.
We have a Super Bowl indicator now, Blake, right?
What's the Super Bowl indicator?
An old AFC team wins or an NFC team wins. AFC is bearish, the stock market. NFC is bullish. It works, it's like
Is it like the full moon type of thing?
I think it's even more accurate.
Really? Well, no, I guess we're in for some bearish action. Who knows?
Tom Brady's short the market now.
Yeah.
Kostas has a question for you before you leave. My
Okay.
colleague Kostas. He's asking you about if you would, he's asking about your reaction to the Fed's dovishness and if you think that if you're troubled or you think that it was priced in.
Oh no, I think this is what's keeping the market afloat right now is the dovish. I think that he was way more dovish than it had expected, and I think because he was way more dovish than expected. The market didn't have that price in. I think that's one of the reasons why the S&P is trading here at 2,700. So does it trouble me? I think what troubles me the most is that I think that I know that U.S. data has been weakening a little bit in recent weeks. I'm more troubled that I think that the Fed might be influenced a little bit by the administration, and that's what troubles me the most, actually. And what's happening in equities. I think they're but that shouldn't surprise anybody either.
Yeah, Powell is clearly hostage of the stock market's performance, and as you mentioned, also obviously influenced by the administration as well. The question is, if this 180 degrees turn due to those two factors does not prove enough to push stocks to new highs, then what's next? I mean, how far are they willing to go to satisfy the markets? That remains to be seen, really.
Right. True. All right, guys. Well, good luck, and I'll talk to you guys tomorrow.
Thank you, Blake.
Thanks, guys.
Thanks, Blake. Thank you.
So, Stel, anything else?
Not really. No, nothing. Sorry.
Okay. Anything about US football?
I have no idea. I've done my best ever sports bet on Super Bowl, but really I have no clue. Otherwise.
When was that?
It's a long time ago. New England Patriots, New York Jets. New York Giants. Yeah. Anyway, it's a long story.
Let me guess. The market was pricing in.
Yeah, it was massively pricing in Patriots to win because they were unbeaten the whole season, and they lost in the last few seconds. It was a great day, great game.
Okay. And what were the odds that the markets were?
It was like 90% chance for the pages to win, something ridiculous.
I'll take that every day. Yeah, of the week.
Exactly.
Yeah.
Exactly.
Okay,
I wish I had more to say, but I don't at the moment. And we have the RBA tomorrow. We have the Bank of England on Thursday.
Actually, what is your view on the RBA? Because I've read Blake mentioned that in his office they believe that the RBA is going to be quite dovish, and I've actually more or less, whatever I've been reading, I see the same kind of dovish expectations. What is your take on that?
Yeah, well, at the moment, Australia is driven by China, and not just at the moment; it's been so for some time. And we have the U.S.-China trade negotiations, and we don't know how this is going to end up. So there's no progress there for the RBA to become hawkish. And also you have the Fed, which has switched to being dovish. And it's very difficult when the biggest central bank in the world turns dovish. It's very difficult for other central banks to just, to either turn hawkish or to keep going. If they're already hiking or anything like that, to keep going. It's very difficult, right? So
it is.
Given that the RBA is not really on a hiking cycle or anything, I mean, they hiked, when was the last time they hiked? I can't remember. Anyway, I mean, the RBA has been doing nothing. So why would they switch to hawkish? I see zero reasons for them to do that. For them to become a little bit more dovish, I get it. There are good, compelling reasons for them to do that. For the two reasons I just mentioned. So I think, on balance, it's actually quite possible that they will be a little bit more dovish than expected. I don't have an Aussie position, but if you ask me to take a position now, I would definitely sell the Aussie dollar into it.
Yeah, and speaking of which, this is a good pass for us to look at. On Friday, actually, we had some nice rejections, both in FX, metals. Now we seem to be seeing the same kind of a reaction in crude so far. So if we're talking about the Aussie, it's worth noting here that the Aussie actually touched the 200 daily moving average on Thursday. On Friday, we made another attempt to push towards the previous day's highs. We failed, and today we seem to be pushing a little bit lower. Now, so far, I wouldn't be giving so much weight on that. But given the fact that the RBA is coming, and given the fact that there is a good chance that we might see some dovishness from there, it's
guys, I was just thinking central banks are a lot like American football. 1, 2, 1, 2, hike. Or don't hike. Time out.
Yeah, anyway. It's funny because everybody now is going to be rushing to actually make sure that they're not the ones left without a chair when the music stops playing. You understand what I mean, Coach?
Yeah,
I mean,
I do.
Now everybody's shifting, to the dovish side, especially after the U-turn from the US. And I bet that everybody's anxious not to be left the last one that seems not to be dovish enough. So,
Steve, I want to ask you this because of your background in economics. Is that even though the Fed is on hold or on pause, that monetary policy works with a very long lag. And if you think about what they've done so far, even if they pause, what they've already done hasn't even yet passed through the system and fully affected, markets, etc.
That is very true.
This point.
That is very true.
Okay.
That is very true. Keep in mind that also people should keep in mind that the Fed can only control short-term rates, right? They can't control the long-term rates. They can control the long yield, right? So they can control short-term rates and they can control monetary supply. That's the two things they can actually control. Now, why they're doing that? Because as you said, there is also a period, at least 6 months, for the effects of change of monetary policy to pass through the economy. But what they're trying to do is that at least make sure that expectations do not also
jawbones.
Yeah, exactly. So it's now in the short term, what they're trying to manage is simply expectations and nothing else. But I have to say something, right? So far, we know that we've had like a huge multi-year, the biggest bull market in history, even though we broke that bull market after briefly, the S&P very, very briefly went in bear market territory. So in essence, it officially put an end to this bull market. But still, before that happened, we had managed to already register the longest bull market in history, right? And big part of which was purely based on, the Fed's put very easy monetary policy, actually very negative real rates, huge amounts of stimulus. I mean, don't forget that in 2008, the Fed had a 900 billion balance sheet, which it had to inflate to roughly 4.3 trillion, in order to stimulate all that rally and asset price increases that we saw. So as you said, now the interest rates have been increasing. The monetary expansion has stopped. Actually, the monetary expansion not only stopped but reversed, at least in the short term. And now they're trying to make sure that at least besides, the fact that all those have reversed or at least, stopped, expectations will at least now be, a lot smoother, that, the investors should not be worried that the Fed is going to keep on going. But as you said, I'm very, very skeptical. It's like an addict. I mean, the market participants were like drug addicts. And as you know about drugs, the more you get, the more you need to get your fix. So I'm not sure that even by staying on pause, now that we went from like 0 interest rates to almost 2.5, and now that we stopped expanding the balance sheet, I think that valuations are so high that if the Fed doesn't keep on reversing and go to monetary easing, I think that the damage is already done. That's why I'm not really a believer in this rally that we're seeing here in stocks. I do believe the fact that with the Fed reversing and us not being in all-time highs, I do believe that we're likely not going to make it to all-time highs, and if we do, it's going to be very brief. If you remember, I said quite early in the reversal that the fact that the Nasdaq stocks that had been leading the rally seem to have been broken from a technical perspective, and I'm pretty sure that those stocks are not going to manage to reclaim their highs in this business cycle, at least, should be enough of a reason to worry that it's not easy for the markets, even if we have a shift in market leaders. I don't think it's going to be easy for the market to sustain this kind of valuation. So I still believe that expectations in the medium to long term should be for lower prices. Now that doesn't mean that this is a prediction for what's going to happen in the next month or the next 2 months. But I do believe that if you close your eyes and open them again in 1 year from now, stocks are going to be lower. I'm pretty convinced about that. Speaking of which, speaking of stocks, and then I'm going to go to FX. The S&P is currently at the 61.8 from the all-time highs to the December low. So this is an area to monitor, and also a little bit higher. We have the 200 daily moving average roughly at 27.43 at the moment, which is another area that you should be paying attention to. Personally, I do believe that some kind of a deeper pullback should take place either from here or from the 200 DMA. I don't think it's going to be at all easy of making it above 28.12, which is previous support resistance, and the 78.6% fib. We have another confluence there before getting a deeper corrective move lower. So I do think that there is definitely no risk reward for somebody to be trying to buy here. If you really believe that this was simply a corrective move lower, at least to have an appealing risk reward, you should wait for some kind of a deeper pullback than the consolidation that we recently had here in a triangle, and then try to buy. At least then you'll have a better entry, because I don't think that it makes sense trying to enter the market here on the long side. Also, equivalently, there is some kind of a floor here in the VIX. Let me actually draw it because I haven't done so in this chart. So if you see there is some kind of a floor roughly at 16 something in the VIX. So I would also be watching this area for a possible rebound in the VIX. So, be a little bit careful here. 200 daily moving average also in the VIX at 16.6, exactly where we are. So, this is another thing to, to pay attention to. So that's what I think about stocks. I think that they're very overvalued at the moment, and I think that this rally has already, I mean, we had one of the best Januaries ever after briefly entering a bear market territory, after having the longest bull run, with economic fundamentals being, worse than they ever were at the peak of, stock market valuations. Don't forget that, speaking of valuations, don't forget that stock market valuations were the second highest we ever had in history, with the only exception being the tech bubble in the 99 peak, 99 2000 peak. So, you should keep all that in mind if you're, thinking in investing with a medium to long term horizon here. Now, going back to the FX world, I'm not going to go over everything since Blake covered that, but going back to the Aussie at the 50% fib here, so far a nice rejection, which can, become quite stronger if the RBA disappoints the bulls here. So definitely ahead of the RBA, I wouldn't be looking to be long here, especially if you combine that with what happened in gold. Gold got rejected from the 78.6% fib, and especially what we're seeing here in silver. Silver, a very nice evening star formation. On Friday, it completed an evening star formation. We actually found the high exactly at the area I was looking for. I was looking for, a rejection anywhere between 16 and 16.20. We got that rejection here, and a very nice continuation today. Keep in mind that we're currently testing a support area, previous resistance support at 1570, but especially if we lose this 1570 level, things are going to start becoming more serious here. Then I'm going to start looking at trend line supports, like, for example, this one. You can see there is a trend line support here, which we're not far away from. I think that if we make it below there,
would that be your trigger to start working the short side, Steve? Breaking the
because I anyhow thought that the rebound higher is most likely corrective. Nice RSI divergence here, nice area to find a rejection. So I'm very, very skeptical. I'm not saying, you can't outright be convinced. I mean, we've had a move higher that started in November, and now we have February. So it's already, roughly 3 months that we've been moving higher. So you can't immediately, with any pullback, disregard the 3-month rally and say, okay, this is definitely the high. But I have to say that, given the, considering the technical factors and where we found the high, and given the fact that we're seeing some follow through, if especially we break this ascending trend line support, I'm going to be extremely skeptical, and I would definitely be looking for a rebound as an appealing risk-reward opportunity to try the short side. Yeah, for sure, Dale.
Yeah, you called it. You called it up there. Grega was on and talked about lower gold prices and a triangle that could go to 1320-ish, I believe. And then Andre was on with his harmonic pattern on Friday, and it's a pip. So, I don't think anyone that's been listening to us or subscribers.
Since you mentioned it, this is a weekly chart, and this is
got caught long. Got caught long. At the minimum, they weren't long. At the maximum, they took advantage of Andre's pip and Grega's call.
This is the long-term triangle Grega was talking about, by the way, and this is the kind of move he's looking for. And I can't say I disagree.
Okay, he also showed a triangle pulling back, like the E wave of this triangle.
Yeah, this one
back towards 1220, and then going and then blowing off again.
Yeah, this is the one. A, B, C, D, E. Very often, E waves do not make it to retest the trend line resistance. So in essence, E wave, since it's the final one, usually it's the weakest one. So you don't necessarily need to see E wave making it to the trend line before failing. Now, alternatively, what Gregor was saying, coach, is that there is a chance, the more bullish corrective pattern is the chance that this was an A, then we had a triangle as a B, so, you have a sort of triangle, and then you expect to see, once this triangle is over, which is going to be over after another move lower, and then higher, you expect to see
that's what I was talking
C, wave C, and then a failure. But keep in mind that is his alternative count. His main count is that the triangle is this, A, B, C, D, E, and we might move directly lower from there. So this remains his main count.
Either way, from up here, there's still plenty of downside, regardless of what count it is. Yeah.
Yes, because
I love when that happens.
Yeah, because
doesn't
even if
matter what's going to happen.
Because even if the triangle is the B of an ABC, you would still expect a move lower from E wave. In this case, E wave is going to be to the downside. You should expect some kind of a pullback as an E wave before getting that C higher. So yes, either case, Greg is expecting, and as I said, I agree with him. Greg is expecting that we should at least get a decent pullback anytime now before going higher, if we ever go higher, because as I said, his main count considers this as this triangle as the whole corrective move, in which case he's looking for gold to reverse lower and not come back until we complete some of the downside targets, which should take us to multi-year, which potentially could take us to multi-year lows, or at least retest the 1100 lows that we had. So yes, the risk reward is definitely appealing for some kind of a bigger rejection. Of course, as I said before, for silver, and it applies even more for gold. After such a move from 1160 to 1320, it's not that you're going to see like a couple of days of weakness and you're going to immediately declare this, the reversal that's going to take us lower. You need to be a little bit more patient. We need to get some kind of a confirmation. What is that confirmation going to be? Is the fact that you want to see the move lower gaining some impulsive characteristics. That's, will permit for us to say that, okay, the move higher wasn't really impulsive. Now the move lower seems to be developing in a more impulsive fashion. And since that, ties up well with the longer term view and the count, that means that I should be looking for the first rebound as a shorting opportunity. And then you can start looking at opportunities to short the metal. Okay, so I think that if you want to play it safe, we would rather wait a little bit longer. Now, crude also seems to be getting rejected from. Keep in mind, this is exactly. We found resistance on Friday, and we retested it today. The 38.2 from the $77 high, which is a multi-year high, right? I mean, the last time we were at $77 before last year was in 2014, right? So this was a multi-year high. We made it all the way down to $42, and it's not a real surprise. We got rejected from the 38.2. We know that the 38.2 is a very powerful fib. Of course, so far, I mean, it's too early to call this a rejection, but I'm paying attention to the fact that we are finding resistance here at the 38.2. So I'm paying close attention to see what's going to happen from here. Keep in mind that I also still maintain my USD CAD short position. I've only taken profits on 1/3 of it. So I don't want, to see some kind of a big reversal here in crude and, lose my profits, although I've already moved my stop loss in profit, but I don't want to give back, all of it. So I'm carefully monitoring what's going to happen here from crude because, as I drew when we were back here, we might see some kind of a rejection from here, move back towards 50-50 once again, and then move higher. So, I want to see what's going to happen today because if we see some kind of a price action that resembles of what's happening in silver, I think that we might see some dollar strength coming through the market. Speaking of the dollar, Blake mentioned it before, but I wanted to show here that dollar actually refrained from making a new low here and we're seeing some RSI divergence also. You can clearly see the RSI divergence here. There it is. So keep in mind that 200 daily moving average also supporting. So I would be a little bit careful with the dollar here, because I wouldn't be surprised to see some kind of a rebound, at least in the short term. And as Blake said, the dollar index has been performing quite nicely, given everything else that's been happening in the market. Now, USD Swiss still remains a much better pair to grasp than the Euro USD. I actually have no comments about the Euro USD. I think it's horrible, and there's absolutely no reason why somebody would want to be involved with it. But if you really want to be involved with Euro USD, you'd rather choose USD Swiss, because I think the move here in USD Swiss is quite clear. We had quite a nice move higher, a bull flag, likely what seems to be a bull flag, and we seem to be continuing from there after finding support at a nice trend line. RSI profile also confirming that move higher. So I think that USD Swiss is a much better opportunity. Speaking of the USD Swiss, we had a question when I was starting, actually, a friend here asking about Euro Swiss. He's saying, hi guys, I'm long Euro Swiss around 1270. Okay, from that is okay from here. Yeah, after breaking this channel, okay, that's a good entry level. And my initial target is 1490 something. Yeah, I think you should be a little bit more careful with your initial target, because the initial target, and I said that when we were trading down there, should be somewhere here at 1445. Why? Because the 200 daily moving average and this horizontal support resistance area is here. So I think that, first area, I would definitely book some here if I was you, and hold the rest of my position for a potentially bigger move higher, in which case I would be looking for 115 as the next target. So I agree with your target, but I would definitely book some roughly where we currently are. Other than that, I think that you have a nice entry point, so I wouldn't be that much worried about it. I think you are on the right side of the market, at least in the short term. Housing data in Australia were quite shitty too. Yeah, Costa, you're right. That's one of the reasons why the market is expecting, a more dovish Aussie, RBA actually. Sorry. Silver trying to bounce from support here. Yeah, 1570 is a support zone, but we've already seen quite a strong move lower from the highs. So I would be a little bit careful, because even if this move lower is corrective, I would definitely expect at least one more leg lower. So I do think that even if this is a corrective move, if we see a bounce from 1570, the initial bounce should also probably be sold for at least one more leg lower. So I do expect that the 1570 area is likely to fail, if not, right here, right now, today, that we're testing it for the first time, at another retest, perhaps, tomorrow, or, in one of the rest of the days of the week, so rather soon. Let me see what else we have to talk about. Yeah, let's have a look at the crosses. Hi guys, this is my first time. I wanted to ask what your analysis on Aussie USD, because I'm short at 72.19. You're short at 72.19. Let's have a look at it, although we already had a look at it, but let's briefly see. 72.19. So from here, yeah, okay. I think we can definitely see another move to the upside before this rebound is over. But ahead of the RBA, I think that, being short here with a stop loss, above the recent highs in the 200 DMA is not a bad proposition, right? So you're roughly risking like 100 pips. And I do think that if we get some dovish RBA today, especially considering that risk seems to be stalling as well. So, a risk-off turn, even if it's in the short term, should also help the Aussie underperform. I think that, it's not a bad proposition being short here against the highs. That doesn't mean it's going to work, but, at least it's a workable risk-reward ratio. Now, let me see. Euro Kiwi. Yeah, we're going to have a look at all the crosses. Pound Swiss is also technically good for a long. Let's have a look at it before we go to the crosses. I haven't had a look at Pound Swiss in, I don't even know how long. You see how long. I mean, we were back then. So we were back here actually the last time I had a look at it, and I was expecting a move lower after a triangle. But as you see, you can never know with corrections because, as it seems, the corrective move was larger. But anyhow, we continued lower from there. Now it became quite harder to read, but definitely this move lower seems like it was corrective. Yeah, I think that, above this trend line, pound Swiss is probably better to the upside. But, having said that, I can't really find a good reason why I would want to get involved with this. I mean, just look at the recent price action. It's not really all that clear. I think there are better opportunities out there. This is not that slam dunk, from a technical perspective. So, in the short term, we seem to be in a corrective move lower, but it does look to be corrective, to be honest. So, yeah, I do think it looks better to the upside, but as I said, better opportunities out there. So let's have a look now at the crosses. So let's start with Euros. So Euros, okay, Euros is looking at a nice rebound from there, but this looks to me like a bear flag. So I would be a little bit careful because I wouldn't be surprised if we saw a rejection from this 158 something area. If we do get rejected from here, but I want to see a rejection, rather soon, then I would expect another push to the downside, at least towards 156. So I think Euros still looking better to the downside in the short term than anything else. Euro Kiwi trading within this descending channel. So, as long as we're trading within this descending channel, you can still be looking lower as well. Now, Pound Aussie. Pound Aussie is barely holding. I think we had a look at this on Friday or Thursday. I was monitoring at this ascending channel. We are making an effort to actually hold it. So it's quite an important area. Actually, we tested that important low on Friday. I said that's support. We're rebounding from there, but unless we see something bigger here, a move towards 180, 170 probably is going to find resistance, and it looks better to the downside than it does to the upside for now until proven otherwise. And pound kiwi, I was looking this as a likely pennant. We also had that horizontal support. It's for now it seems to be holding it, but if we do break and close below this 189 area, I would be expecting for a continuation, at least a retest of this 183 confluence of this ascending channel support and horizontal support resistance area. So, if we close below 189, I think we should make it to 183. So, it's quite important what the market's going to do from this exact level. So you want to be long, this is a great risk reward opportunity to be long. So if you like it for some reason, on the long side, this is a great area to be long. But if we do close below this area, I would definitely not be long. Okay, because I think there is at least one more leg, following to the downside. This move higher so far looks corrective to me. Okay, so CAD yen, Euro yen, USD yen, Aussie yen. Let's have a look at them one by one. So let's begin with Aussie yen, since we have the RBA today. Aussie yen, quite important area of resistance here. Why? Because it's the 50 DMA. It's, if this was a triangle here, which is a likelihood, it's previous support acting as resistance. And add to that the fact that this rebound higher does not inspire me. If I ignore this flash crash week, doesn't inspire me as impulsive. So I would expect that the upside should be very limited from here, and especially ahead of the RBA. I think that it's not a hard decision to choose to be short if you want to do something from here. Okay, so I think that Aussie yen looks quite well positioned for weakness from here. Okay, CAD yen. Let's have a look at it. Same deal here with the CAD yen. First of all, let's look at the big picture first. CAD yen, quite a strong move lower, a rebound within something like a pennant, a breakdown in an impulsive manner, a rebound then in a corrective manner, a breakdown in an impulsive manner, and so far the rebound looks corrective to me. I like very much this confluence of resistances, which is higher from where we currently are, 84.78 as you see, is the confluence of the 61.8% fib from that high to this low, and also the 200 daily moving averages there. So ideally, in an ideal world, I would want to see something like this here. Okay. So also, as you understand, I would not be buying CAD yen here. No way I would be buying CAD yen here. I would rather be looking for a good opportunity to be short as long as we stay below this confluence of resistances. Okay. So CAD yen looks decent to the downside as well. Perhaps not as ready as the Aussie yen, which is already at resistance, but not far away from it. Now, having to do with the USD yen, I also view this as some kind of a corrective rebound, but I'm not sure yet what's the nature of it. Is it an expanding triangle? Initially, I thought it might have been like a flag, but we dipped a little bit lower from that flag, so I had to readjust this support line. So perhaps it's an expanding triangle. Perhaps it proves to be something else. But one thing is for sure. As long as we remain below this horizontal support resistance area at 111.50, I would be very cautious, especially I'm looking very carefully at this confluence of resistances at 110.80 roughly, because it's the 61.8 of this high to the lows, and also the 200 daily moving average is converging there. It's not even, it's like, 8 pips away. So I think that the move towards there and the rejection from there will make it a very, very appealing risk reward opportunity to look in the short side. So, especially combining the view that we have in the Aussie, the possibility that crude might reverse in the short term lower, which should help CAD underperform. Of course, if I see signs of that happening, I'm going to close. I'm going to take profits on the rest of my USD CAD. Also, the RBA and the potential for it to be dovish today. I think that Aussie yen, CAD yen, all of those, as we also saw from a technical perspective, don't look that bad, as shorts from here or from just a little bit higher. Okay. Can you please have a look at the FTSE and the DAX? I would love to do that, but I don't know. Coach, do you have an interview today? Because if you do,
Peter's in the house. Peter's in the house.
Okay.
Peter at MCM_CT.
Okay. So Peter's in the house. We're going to cover the European indices tomorrow. Or if you're a ForexAnalytix subscriber, just try to mention me in the chat, and I'm going to send you charts. Okay. Thank you, Coach.
Okay. Peter, is that you, Peter Desario? Because there were 3 Peters in here. Can you put something in the question box? I'm not sure of your last name. Peter at MCM_CT. So I'm not sure what's happening here. I'm going to go with Peter Desario.
No, I promote him. I promote him.
Okay, Peter.
I think it's Peter, mate.
Okay. How you, Peter?
Hey,
Okay. No,
Can you
Peter
hear me?
Campbell. Yes, I can hear you.
great.
Is this Peter Campbell,
Yes.
correct?
This is
Okay. Okay, Peter. MCN_CT.
Yeah, that would be it.
All right, buddy. All right, so I'm going to give you the screen too, so we could see your setup. I think you're just a panelist. Yeah, I'm going to make you the presenter, and then you could share your setup, and it's great.
And if the yen is basically going to strengthen, we're going to end up unwinding carry trades. And if the dollar strengthens, that's going to make a very sick environment for the carry trades to be unwound into. Sorry. I can't believe I said unwinded. But anyway.
We'll edit it out. We'll edit it, buddy.
Perfect. Basically, from where we are in the dollar cycle fractals that I look at, we are in the danger of breaking out of significant impulses higher. And I discussed this last time. These are cycles. So wherever I get this magenta line, for example, that is a resistance cycle. And I talk about these things on Twitter quite often.
Yes.
And these are like sort of the way I would refer to them is you have energy, and energy, you can think of it as an ocean. And in the ocean, you have oscillating waves that basically do not transport fluid or material. They just oscillate, and you basically are moving up and down and sideways, not really going anywhere. And then you have currents and larger waves. And how those currents and larger waves sort of end up happening is most of the time, out of collisions of oscillating waves that collide in a way that create force. And so when I get a resistance cycle here, this is basically cycling energy. It's an oscillation energy. It's sideways, more or less, energy consolidation.
Yeah, those are the waves doing nothing, right, Peter? Yes. Kind of like a cork bobbing up and down in the ocean, going nowhere.
Exactly.
Okay.
And, you can go somewhere, like you can see here, we have oscillating waves that are going into a high for the dollar over here, and they're oscillating. They're not impulsive. Now, what creates an impulsing wave is when you collide with enough energy and break the oscillation. So that means that you have several oscillations or several causes potentially that come together and release energy sufficient to break the oscillation, which then creates a transport mechanism. And that, so impulsive waves, kind of like Elliott wave, create direction and travel. So they price travels. So what we have here on a quarterly chart is, I believe this is a quarterly chart. Let me just see.
So this is for directionality. It doesn't provide amplitude for you for targets. It's giving you the direction, correct?
It's giving me context, time, and general sort of direction. Yeah. Okay. So the biggest thing that I like to use in trading is time. I like to understand that the time and the use of time is very independent of price, and so time can move very. You can extend in price, but correspond to a very truncated price. I mean, a time window. So time for me is actually more important than price a lot of times, because I can't predict where a price will end. And in the example is in this ramp that we have off the lows, there's so much intervention and other kinds of forces going on. Time actually represents a better mechanism than price in a lot of senses to understand when you've exhausted the energy transmission and release. And that's what this is about. So I just want to finish this. On the quarterly chart, we have an impulse where we broke out over here, if you guys can see that. And then we have this bullish retracement. Now, in currencies, what happens is that a bullish retracement like this can send the market like way, way up. And this is a quarterly chart. So the usual scenario is that we're going to get another 3 or 4 quarters of strength on the dollar. Now, these are energy-based charts, so it's very different from looking at a fundamental analysis. And then what we see on the monthly chart is that we have had very good oscillating energy, and there's been no impulses here. It's just been oscillations. So when you get oscillations for this length of time, if we break out over this resistance cycle, we're going to get a monthly impulse. And the monthly impulse is going to send this thing flying. Now, what we have over here on the weekly chart is a monthly impulse, a weekly impulse. And what you see is we broke out of the weekly impulse, and I've been posting that we need to remain above basically 93.85 for the bullish case. I would say 93.60 on the DXY index for the bullish case. We could overshoot a little bit, kind of like what happened here. But that has been the case. We have been remaining in a positive impulse structure on 2 very long time frames, and at the risk of breaking out of an impulse over 97.03. So if we break 97.03, which I think has a very high odds of happening because we're in nested impulses, then we're probably looking at 106 to 109 on the dollar in pretty short order. And that says something about the world and about credit and about other stuff. And so, how I see this is the
deflationary, right, buddy?
What?
Deflationary.
Yeah, deflationary. So what I think we're seeing is a deflationary cycle where every time we get a little deflation, basically the powers that be panic. And that's exactly what the Fed did. But the Fed has created a situation in which the results of the handiwork are global. And the ECB took the baton, and Bank of China and Bank of Japan. And you just reach a point where people created too much credit and too much deception and too much stuff, and they can't get it back in the box. And I think that's where we are. So the go-to instrument, the dollar.
Yeah, I'd like to pose this to you just quickly before you go into the dollar. Technically, is that what the Fed and other central banks do, have a lag time before they hit the economy? So even if the Fed is on pause, on hold now, we haven't seen the effects of what they've already done?
Yeah, and that's a really important point, is that depending on how they act, the lag time, certain things could be 6 months, but most of the time it's 9 months to 12 months.
Okay,
And
I didn't know that. Thank you.
the lag times are very long. And the policies that the Fed has are very imprecise. And the problem is we have a bunch of central banks who can no longer cooperate. And then we have a situation, well, they can cooperate, but they cannot cooperate well. And then you have a tremendous amount of dollar denominated credit that is not in the U.S. And so
emerging markets you're talking about, they have dollar denominated debt.
Yeah, in Europe, in China has been, in their thirst for leverage, they've been creating more dollar denominated loans in China than they have for a very, very long time recently.
Interesting.
So it's not something that people are aware of.
I didn't know that. Yeah, I didn't know that they did. How do they do that? What kind of instruments are they? They just bank loans based in dollars instead of won?
They create bank loans denominated in dollars. And people apparently buy them or want them because they buy into this idea that the dollar will go down and they can buy the loans back cheaper. I really don't understand why somebody would go on a suicide mission like that, because it just doesn't seem very logical to me. Every time emerging markets gets sold on the idea that you can denominate debt in dollars, when it's widely adopted, the next thing they have is a crisis. So I think the dollar is the key. And I want to just show you right over here. Here is an example of an impulse. So we are in an impulse here, and it's a long sideways consolidation at this point. And this is not unusual. But if we hold this support, we can easily get a move like this in the dollar. And we're already on a quarterly chart in something that it will need some effort to get it unwound. So this energy, so here's an example of this upward impulse. So we get an upward impulse, or we get this upward impulse, and we need 2 ends or 3 ends to dissipate the energy. And what that means is that you have at least 3 oscillations after a big impulse that are required to sort of transition the energy from directional energy to consolidation energy, which then can either create a new impulse upwards or reverse downwards. And
interesting, the number 3, Peter, because, I teach and look for a lot of 3 drive formations. So from your methodology, it kind of verifies that 3, and you're right, there's sometimes 3 drives to a top or bottom, the formation fails because it ends up being a continuation move instead of reversal, but kind of confirms to me that 3 is a very important number.
It is, especially when you go to longer time frames, like here on this monthly chart. You can see we get a third end down. So we had a large sell-off in the dollar for an extended period into 2000, basically 9 or 8 or whatever. And it took until we got the third end to put a base in. And then all of a sudden we started getting moves that were upward direction. But we still haven't had a monthly impulse up. I'm expecting we're going to get a monthly impulse up. And everybody in the world right now is looking for a weakening dollar because they think that the Fed is going to loosen the policy. And the problem is really, I think, bigger than what the Fed can handle. So that's why I wanted to start with the dollar, because I think that the key to the dollar right now is 93.85-ish, 93.60. If we can remain over that, I think that we breaking out over basically 97.03 could trigger a gigantic move in the dollar. And I think that when you look at where we are, basically around 96, this is not a lot of room. The dollar is at a point where a decision can be made, And for a lot of the people expecting very big declines in the dollar, it's not cooperating. It is not cooperating.
Yeah, didn't last week kind of show it? They gave the dollar bears on Fed Day and the press conference everything they wanted to hear. The dollar got hammered with no follow through the next couple of days.
Exactly. And then look at the dollar versus the CNY. I mean, there's something wrong. Look at the dollar against the Japanese yen. And when I can see the dollar holding up like it is and the Japanese yen as strong as it is, well, we are heading for, I think, an epic crisis. This is not a small deal. Now, I have been...
Let me just clarify for our viewers. When you talk about yen strength, are you talking about U.S. dollar Japanese yen going up or yen strength with USD Japanese yen going down?
What I'm talking about is the Japanese currency strengthening against the U.S. currency.
Okay, well, that means USD JPY will be heading south.
Yes, and that means in general that we would be looking for the dollar to weaken globally in that scenario. So you would see the dollar dropping in a pretty big move if the rest of the world's currencies agreed with the yen. But what I don't see is that happening. Firstly, the dollar remains extremely strong relative to what's been going on with the yen, in the dollar index.
Right.
Now, and then I think that the yen itself has been very strong, and I think it's going to break out as we end up with greater crises in Japan, which is the source of so much of this exotic monetary policy. Whenever the Fed
a 112 level come into your work at all in U.S. dollar yen, Peter?
That was
110.05 right now, so another couple.
Is a key number, and I would like to come back to you with I can maybe send you a few charts of the dollar yen cycles. I didn't prepare them. They're really interesting, and we are going to have very severe consequences when the next set of cycles break out, which is right here on the dollar, and the yen is a similar situation. What's so great about these charts is they're energy charts. They're about the passage of time and the transmission of energy. And so that's why I like looking at things this way, because
this is your stuff, proprietary stuff. Did you borrow anything on time from Gann, or it's all your creativity that came up with this?
There's a lot of influences that go into this stuff. And
nothing new under the sun.
Traders was a good influence from Elder. So, and there's other people too, very talented, who've influenced me in thinking about this stuff. But I've come up with taking things in pretty different directions personally. But anyway, the dollar is something I really wanted to just say. We know that something's going to be wrong if you see the dollar's over 97.03. And I believe that's going to happen. And I think if the yen is very strong at the same time, then you have to be prepared that we're going to have a banking crisis. And you're going to have some sort of huge crisis. I don't know what it's going to be, where it's going to be, but I'd have to believe that it's going to be Europe and China. And to that end, this is a chart of, you've probably seen this, and I think a lot of the popularity of this chart actually has been because we've been posting it a lot, which is
what year is this fractal yellow line taken from?
Well, I'm going to recalculate this. Okay, this is the Baltic Dry Index. Shifted 25 days, 25 trading bars in advance in the future. So it's a very interesting fractal because as globalism has been under more of a threat, this fractal has been incredible at calling bottoms and calling turns. So if you look at it here, it's saying, okay, we're going to go through some sort of a pullback, and we do. And then if you look right here, you can see that it says we're going to bounce, we bounce, and then we pull back again. So these are in advance. So it's basically saying, okay, look for a little low here, look for a little high into around about here, and then look for continued pullback. And then we get this huge trade push, and it nails the high into January, into the end of January. And this is in advance. This is where the Baltic Dry Index peaked. And basically, we had the same situation happening at the end of the year this year. And now we have a period which should have had seasonally strong behavior from the Baltic Dry Index, which was very weak. And when you get a weak fourth quarter in the Baltic Dry Index, you should get a strong first quarter. But what we've had is an exceptionally weak first quarter in addition to a weak fourth quarter. So this to me is extremely troubling, and we can zoom in and take a look at how well this has worked. So the dark line here is the non-shifted Baltic Dry Index, and this is the shifted Baltic Dry Index. And basically, plus or minus a day or two, has pretty much called the lows and highs in the market. So here we are right now. So I would say that what it looks like to me is that from a global trade perspective, we're looking at some very serious problems. And from an economic perspective, we're looking at very serious problems. And so I'm expecting that regardless of this intervention that has happened, which has really been verbal more than anything else.
Except China did do some infusions.
Yeah, China has done their infusions, but the majority of what has happened has been verbal, and China's intervention has been very ineffective. So even though they tried like hell, their intervention has been ineffective. Now, a lot of people are used to the bull market. They're used to the idea.
Buy you every dip. Or as they say, BTFP.
Bad news is good news. Good news is good news, etc.
Yeah. Right.
The difference between markets under liquidity stress and the markets that are not under liquidity stress. So I call that a bear market is a liquidity stressed market for me. I don't really consider a bear market 20% down. I consider a bear market is a market where you are liquidity constrained. And when you have a situation where we have liquidity constraints for available funds for the equity markets, and the central banks are not creating new liquidity. So we are not seeing China created some liquidity, but they're not creating globally enough liquidity to have sustainable
I get it.
In risk.
And the Fed, Peter, even though they've paused on rates, they are still draining reserves every month on their balance sheet, right? And jawboning, but they're still tightening.
Yeah. And so I want to actually talk about that a little bit more, because I think it's so important, especially to the currency markets, which I'm very big into dollar, but I'm not really running around trading all the currency pairs. But I believe that what happens when you get into a liquidity constrained environment is the psychology of people changes, where they trade based on hope. And then when reality is delivered and hope is no longer there, they realize that the hope was great and the reality was not nearly what the hope said it would be. So I believe that if Trump was to get a Chinese deal, it would not turn into something positive for the stock market.
Okay.
And
might be an event to sell into.
yes.
Okay. You want
I
a
also
Pinkertism on hope, Peter? Hope is here's a Pinkertism on hope.
Yeah.
Hope is the oxygen in our life and the carbon monoxide in our trading.
Exactly. And that's what I believe the central banks and officials tried to do was to create hope, and the idea that the markets could return to the previous style of trade. And we've had this humongous rally, both based on verbal intervention, probably some banking intervention, and a tremendous amount of hope. I think that we're going to unwind this probably exceptionally fast. I think people who are bullish probably will not get the chance to unwind in the way that they would like. And
from these levels, Peter, from these levels, or is there some fumes left in the gas tank of hope before?
Lit on hope. So my view of it is that there's not much. The valuations in the market are hysterically high right now. So it's much, much worse than it was last year. Earnings are down significantly. And here we are with prices, that were intolerable for people, not long ago in October and November. November and December. And earnings are continuing to come down. Liquidity is continuing to contract. So that's why I think this Baltic Dry Index is important. And I want to go to another chart that I posted yesterday. Basically, where we are, this is not the same chart, but it's similar. I maintain a chart of, come on, stupid thing, of...
we see it.
I know I'm trying to move this damn thing and it won't move. Oh. I maintain a chart of the volatility indexes. Let me just see if I can zoom in and get this to move, because I don't know why this is doing this. There. Let's see, where is this bottom? Okay, so the reason that I drew these two boxes was for you guys. Wanted you to see just how this is aggregate volatility. This is all the volatility that there is that I can track reasonably. There's other volatility that I could actually add to this. The problem is I don't have enough of a history on it. It's like you have like 2 or 3 years of some of the instruments and it's not worth it. This is enough. So, but the point is that this is the amount of volatility that was triggered into the lows of 2000 in 2009. And here is the volatility that was triggered in total at the bottom of the February lows.
Right.
Now, what you can see here is that we moved almost twice the amount of price of the February lows.
And vol underperformed on that.
The total
trip,
volatility.
right?
Yeah. And so what does that say to you? To me, as a trader, it tells me that the market was not emotional. They weren't really that scared of it. People sold volatility. Now, whether that was central banks and Powell.
That's what I was going to think, that, it's easier to manipulate the VIX instruments than it is the overall market. What do you think?
I think it is, but it's changing. And I'm not sure if the Fed is really, they used to have an almost $3 trillion short vol book. I'm not sure if they're expanding that again. Powell was in charge of that, and he was supposed to unwind it, and I believe they, for the most part, did. And that was part of why we had this vol implosion over here, the vol explosion. The other problem with this is that we have more and more funds. I think it's easy to credit the central banks for manipulating vol, but it's very important to understand that a lot of the vol manipulations are coming from strategies which are aiming to do volatility targeting or volatility control. And so what they do is they look at if the volatility is rising in the volatility products, they look to lessen their long exposure in S&Ps, either the SPY or the futures. If volatility is declining, they look to increase their exposure. And this is an algorithm. So there's a relationship between the two. And so it's a self-iterating fractal. The more people reduce their vol, the more vol is reduced, the more they buy the S&Ps. The more they buy the S&Ps, the more the vol is reduced. And on the way down, it's also the same. Now, I think that we haven't blown out the volatility, the short vol people, and these strategies are beyond ludicrous. They're stupid, they're risky. They're used by insurance firms who actually want to pretend that this is a safe strategy. And what it really, to me, is just another tail that wags the dog. So we have ultimately, I think, a situation in which vol is going to basically get blown sky high and I think break out over this trend line and probably way exceed the 2009 lows. Now, in that end, I wanted to talk about my work is pointing to an initial target on this next move down around 2050 and an ideal target of a support zone around 1820 to 1850. So this move is very likely to be much bigger on the downside than people are thinking. Now, I don't know what kind of bounce we're going to get at 2050, and I don't. Maybe I'm wrong, and maybe they can come out and try to save everything, but I don't think so. I think that in this chart, I'm showing the reasons why I don't think that's going to happen. Why I don't think they can save the market, because we were too complacent as a whole. And I was posting this live also that at the lows, these were not final lows. I covered my shorts into the 2400s area, 2470s. So, and basically in the upper 2400s is where I was closing my shorts, and the remainder of them I closed, I think, in the middle, and just sat it out until 2340, and then was more or less biased long after that stabilized there, and then also when we retested the lows at 2440. Now, my expectation was that we would come back up to 2630.
Okay, that's a point. Great segue. So a lot of people started selling this bounce at 2600, 2650, 2690, right here at 61.8. Do you think the rally sellers have been exhausted yet, and now they're tired of trying it, and that could also open the window that we've had massive short covering during this advance, and now we're getting close to where the bears are scratching their heads and saying, yeah, you know what, I'm tired of shorting this market. It's like
I actually 100% believe that's the case.
Okay.
I believe that what's happened is that from what I was seeing, nobody really wanted to hear at 2,500 about going long, and that the market was going to go up 100 to 130 points. I got a lot of flack for that. And now it's funny because people only notice that I started to get short a little bit earlier than what I had targeted for the market, because that's what I usually do. So I thought we would get to 2616, 2630, and I started getting short in the upper 2500s just to get the toe in the water. And I maintained a short exposure since then, and have raised my average short price to the 2650s, and trade it around also. And I do something that I would recommend other people do, which is I take long trades when I'm short that are basically designed to offset my short position, and I don't do it in a speculative way. I do it in a risk offset way. So, for example, let's say that I had 500 ES contracts short. I might trade 50 lots long. And so then I'll throw, 5 or 10 shots at being long, and I will be consistently limiting my risk and reducing my margin exposure as well. Because if I'm 50 contracts, if I buy 50 contracts of ES and I'm short 500, I know I'm short 450.
Yeah.
And,
yeah, it's like a hedge. It's like a little bit of a hedging thing, and you see a rally coming, so you hold a core position and trade around it.
Exactly.
Both sides.
The thing is, this is where time is such an important element in trading. I have a swing position which might end up getting, like last year in 2017, I got 3 trades that were around about 300 points or greater in my trading, which is a very unusual thing to do. I have not done that before in 1 year. So that's, and basically what happens is that you hold those trades, and I'm thinking that we're going to get more than 300 points down now, or 400. We're probably going to get 600 or more. And so during that time, I might be holding this trade for another month and a half. But during that time, I get to maybe potentially do 30 or 40 or 50 or 60 long trades. And that is using time to your advantage. Instead of just sitting there in a position exposed, you can do other things that are specifically mentally liberating and also offsetting the use and allocation of risk in one direction with a very objective way of reducing that risk and using time to your advantage, where you can take multiple stabs at stuff. And I use a tool set called Tick Tools, which I have shared for the time being publicly on the internet, so that people can hopefully do the same thing to a degree. Let me see if I can. Let's see here.
And
so
also, Peter, after that, for people that are hearing us live and watch the video later, the best way for people to follow you and get in touch with you.
Okay, well, on the website, on the Twitter, it's MCM_CT.
Right.
Which is the easiest way to find me.
Okay.
And for right now at zoom.us, I have a free share, kind of like what you guys are doing, but no talking. It's just showing Tick Tools live signals. And basically, I'm going to try to see if I can get it here. So all you do is you go join a meeting. So you click on join a meeting, and it should ask. There it is. And the meeting number stays the same every day. It's 533. I don't know why this is so slow. 533-3355. And then you just join, and you can see the charts in real time. And what Tick Tools does allows me to, I can actually show you a rough chart of it here, where we are. Come on. I think that webinar, so come on. I can't.
Make that
Maybe
mouse
it's because
run.
of my.
Make that mouse run faster around the wheel that's powering.
Yeah,
your,
I know this is my laptop,
today.
so I don't know what's going on with it. But
I use one too.
Tick Tools is an amazing tool set at analyzing the real-time emotions that are going on in the marketplace. I fixed it.
Okay.
And basically, here finally it moved. Okay, so. Let's see if I can. something's going on with my machine. I can't show you my charts.
All right, but that's fine.
But
at least people know.
Nonetheless, a really interesting chart, by the way. This is this is vol adjusted for flow, and take a look at what it's suggesting vol should be. So the VIX index should be about 34 right now, according to which is an interesting subject. And let's see, there's one other. Here's another chart, and I want to show you guys this because now I see what's happening. Okay, we had the market open, and I have tons of data that reloads, and so it's reloading and recalculating, and that's the problem.
Okay.
But basically, there's a bunch of participation indexes which I have, and they have all been extremely moderate on this rally. So where I see a lot of people on the internet talking about advanced decline line is very strong. It's here. It's fine. Where I see a lot of people talking about advanced decline line is very strong. Come on. It's this machine is recalculating a ton of stuff right now, and that's the problem. So I didn't expect that. But what's really happening is that advanced decline is not a good measure for the market anymore. Advanced decline is a corrupt measurement of the breadth of the market. And the reason it's a corrupt measurement is because we now have more ETFs in the US markets than we do stocks, or at least equal. And ETFs are considered a part of advanced decline. So you basically have a situation where ETFs are constantly affecting flows, and then you have a situation in which the number of stocks is continually declining. So the number of stocks that we are trading, or that you see that are trading live, are down by, I think, about 70%, 68% or something like that from 2000. So the universe of stocks to trade are down incredibly.
Yeah.
And each time you reduce the stock, you now have less places for liquidity to go. And so if you're comparing yesterday's advancers to today's advancers, you have less stocks today. So that's going to make your comparisons always look more positive. And the same thing is going on because we have still an episode of buybacks, which is still in progress at a very high level, which continues to.
I wanted to ask you that. Someone I interviewed said that February was a blackout period for buybacks. Is that true?
During earnings, yes.
Okay. So until the earnings season is over, there are no buybacks going on.
Well, they're limited, yeah.
Okay, but not the whole month of February.
No. And so so the point is that let's see if this is still not reloaded. Okay, here we go. This was a chart I wanted to show you, but it's going to take a while to calculate. We just had the unfortunate.
Yeah. So, but you know what? Don't sell yourself short, because you gave us enough pearls today in 48 minutes to string a necklace.
Well,
so I would I have to thank you. I mean, I never followed Baltic with the market, and a lot of the things that you said, give me conviction for what I'm planning to do. And really, I thank you so much for coming back. And I wasn't sure, but this was even better than the last one. So appreciate you edifying our community, Peter.
Yeah, well, it's fun to speak to you guys all the time and every time, and I appreciate being invited back.
Okay, well, let's do it again a few months down the road and see how things are playing out. And I wish you nothing but pips raining down on you while it's raining in the economy, Peter. So good hunting, and stay in touch with me, my trading warrior brother. Okay.
Okay. Yeah, you too.
All right, everyone, that's Peter Campbell. You can follow him on Twitter at MCM_CT and go to his website. And this guy is a very creative, deep thinker, musician turned analyst trader, and should be part of your intelligence gathering, in my extremely accurate and humble opinion. So that's a wrap. And many people are saying here that they're going to be following you, Peter. Remember, don't just count your pips, count your blessings, and we'll see everyone for Turnaround Tuesday. Adios. Thanks again, Peter.
Okay.
And the video will be produced and out in a couple hours, my friend.
Well, you know
Adios.
what? I actually can show you this index now if you guys would be interested.
All right, go ahead. I won't end it. Go ahead.
So let me just, this will take 2 seconds to recalculate now.
All right.
There. Okay. So basically here we have, this is something that I do that not a lot of people do. I actually calculate what volatility indexes should be. That's this red line. And this blue line here is realized vol. So the volatility indexes are still trading at a significant discount to realized volatility, which means that we should be expecting some sort of a volatility upsurge relatively soon. And then this is the participation index. This is sort of derived from Tick Tools, execution sentiment index, run on multiple different ways. It's very tedious and very time consuming to calculate, which is why you saw my machine basically grind to a halt. What you can see is that ever since we had this end of the year move into 2017 and early 18, we've been getting sold into. So then we have this big move off the low. And one of the reasons I was positive about the initial move into about 2,600 was because we had decent participation. Since then, from here on out, participation has been horrible. So what we're looking at is people selling into these highs. Now, if you use the advanced decline indexes and you use regular tick and stuff like that that people have on, that you can get in, stock charts, for example, it's useful, but it's very important to recognize that the frailty of the markets is one where we have created an echo chamber that is self-reinforcing of positive expectations and positive hope. So one of the ways that happens is when you reduce shares, you reduce issues that are traded, and you make comparisons between history that is not comparable to the future. So if you're doing advanced decline line assessments today and you compare them to last month, you're not comparing the same market. You compare them to 6 months before, you're not comparing the same market. We have more ETFs coming out. We have less stocks to trade. We have smaller floats in each thing. It's very important that people recognize that these things that people think are objective are not objective at all. What they are is an echo chamber. And if you want to know what's happening in the market, this index is telling you that we're not getting participation into each one of these highs. And now on this really big move, we're not getting participation. And we did initially get decent participation into about 2,600. And that's why when that started to sort of lessen, I felt like we had a decent shot at a reversal somewhere in that area. And this behavior from here to there has been rather surprising to me. And I think that it's going to end very much like this. So if you look at the last time that this happened, we had some decent participation, making some highs. And then we had lousy participation into the final highs into September 21st. And then what we ended up getting was a disaster. And,
I had a guest on who said this: the market's job is to convince us it's something it isn't.
Exactly.
And when you talk about AD, that kind of reminded me of that.
Yeah.
So
this was a very, if I was able to help anybody in taking a skeptical view of what's going on with advanced decline and tick, I like the tick index and I use it, but very rarely, because what I needed to do is I needed to write my own tool set that goes and looks at every trade and then calculates a more meaningful number out of those trades than something that is going to be filtered through this echo chamber. And that's what these tools are about. And that's what gives me this ability to say, okay, well, what's happening in the market? And I can tell you it's being sold. So, not a lot of people can do that.
that's why I had you back, bro. So you just added conviction to, there's this thing called a February break. I'm expecting a lot of markets had banner Januaries. I'm expecting the air to come out of the balloon in February, and most markets that had very good Januaries. So
I think you're right on the money there.
All right. So happy Valentine's Day.
Thank you.
All right,
Thank
buddy.
you for inviting me back. It's always great to speak to you, and I appreciate everybody being a little patient with my machine basically grinding to a halt when the market opened.
You know what? Every minute was worth it. Thanks again, Peter. Good hunting, and keep in touch, please. And good luck on this call.
Okay. Bye-bye.
All right, everyone. That's Peter Campbell, and everyone knows where they could follow him, and I recommend you do so. So with that being said, have a great afternoon, great evening. See everyone for Turnaround Tuesday. Thank you, Martin. So Peter, another great interview, Martin Cinder said. So thanks again, everyone. Enjoy your day. Don't just count your pips, count your blessings, and we'll all see you here tomorrow morning. Adios.
Okay.